Investing is all about paying X today, hoping to get X plus Y tomorrow. Without growth, you can't talk of investment returns.
When you speak about predictability, what makes a business predictable?
Business is brutal, and without growth, meaningful value cannot be created. Everything is a probability. The game is to define how much probability is more credible and how much of the probability looks completely like a chance.
How do you act on the understanding of predictability of growth before the market discounts?
When you try to act very smart with the market will get an account of you.
How do we size the opportunity of something in a right manner?
I was foolish enough to recognize it only after a fair bit of damage had already done. A lot of time people say expensive learning, but good learning is never expensive.
You have the fiduciary responsibility towards the hard-earned money of your clients. How do you balance between wealth preservation and the balance between go on and take some kind of risk in the market to appreciate that wealth?
In the capital allocation, even the most ethical managements can stumble. I used to think how smart and how clever I am. Then I realized that it was actual nightmare. I'll not say that one has to be a monk in Himalaya and forget about all of that. It's complete nonsense.
You meet a lot of businesses, you meet a lot of promoters, you try to understand and learn from mid-size, new age, old age businesses. What are some questions that you ask the promoters and the businesses, which you have observed deriving most amount of insights? So for example, when you are meeting a promoter and when you are meeting a business, so you want to learn more about the promoter as a personality, and you also have to learn insights from the business. So, we believe questions are like keys which unlocks a lot of insights, and we are attempting to unlock those insights with questions. So the question is, what are some questions that you ask these promoters and businesses to get maximum amount of insights?
One category pertains to the man himself, the promoter, and the thought process. And the second category broadly pertains to the business itself. I think for a business that you are kind of interacting for the first time or relatively rather recently, the first category of questions becomes very important. The mind of the promoter, the thought process, and the kind of bundle of attributes that you believe or you kind of look out for together that the promoter displays. One interaction or two interaction or five interactions can't tell every single thing that is there to know. Therefore, all of this is a part of a long continuum to evaluate and understand a promoter or a management better. But you have to begin somewhere, and therefore, when the interactions are at the early stage of that business, or for you relatively recently with that promoter or the management, then the questions about their psyche, their thought process become very important. Therefore, their vision of the future. At the same time, their ideas about how they want to execute that vision or a future envisage into a concrete outcome. Capital allocation thought process is very, very critical because it is in the capital allocation that even best of the managements, even the most ethical managements can stumble. They can trip over while making a capital allocation decision, because success in a particular activity or business that the management may have shepherded till that point of time, when a significant capital allocation decision comes, which is either significant to the existing business or entirely to a new activity, either related or unrelated to the existing business, always are crunch decisions. And therefore, how will they envisage, how will they allocate, and how much they've thought about it, both the pluses and minuses, is very important to understand. Therefore, capital allocation philosophy, not just the actions, and the kind of homework that you want to gather, what has been done. The other aspects that you invariably want to learn by observing them is the fire in the belly. Ultimately, young managements, by young I don't mean necessarily youth of the people concerned, the youth of the business, I'm saying, the fire in the belly to convert what is a youthful avatar of the business into something significant over a period of time is a very material criteria. Because investing is all about paying X today, hoping to get X plus Y tomorrow, with a difference of Y being your returns. And that Y is typically function of how much has the business become from X to whatever at a measurement point of time. And that is nothing but growth of the business. And therefore, fire in the belly, determination to achieve outcomes, ability to at least visualize contours of that opportunity properly in the mind, so that one is not stuck with what is there on the ground, but constantly thinking about unfolding future. So all of these requires one to have that determination, that fire, that willingness to not stop, but to keep going and to keep achieving more. Then the mental resilience that you see. No businesses are free from challenge, and no businesses give you lottery kind of a right to win, even best of the businesses. And therefore, the mental that resilience to deal with the challenges without getting cowed down, without getting kind of run roughshod over by them. What kind of mental equilibrium and balance you have? The challenges invariably will come in the business, much like in markets. But how you deal with these challenges, how will you live with those tormenting times, and yet having eyes firmly cast on that future. All these are very vital aspects of the management, and therefore these are some major ones, I would say, but many more. Even the fundamental attitude to treat the other shareholders well, and the basic value system, the basic governance behavior that you can kind of try to discern in the dialogue with them is very vital, because ultimately you're riding on somebody else's capability and the mindset, which not only includes competence but also integrity. And therefore, making a kind of a judgment on that is very critical. That way, they'll be fair to you, they'll be fair to the others in the same way, and they will not put a precedence on their own interest at the expense of others. Therefore, there'll be fair shepherding of the interest of each one in the respective proportion, of course. It is the size of opportunity which will let you think about where the puck is going to be, not where the puck is. And investing is all about where the puck is going to be. And therefore, size of opportunity is something which will take you over there as to where the puck is likely to be. and whether the management thinks about it, whether the business has got what it takes to be differentiated and much more different in size and character and strength over in future is vital for you to judge. Secondly, that is simply because that gives you a insight into likely growth rate. Because the likely growth rate is a function of both the capability of the management and the character of the business. Once the size of opportunity is kind of put in place. Therefore, union of or the intersection of the size of opportunity, management capability, and the business character really translates into the growth rate. And growth is critical because without growth, you can't talk of investment returns. The world of businesses is brutal, much like in the nature. It is not how bright or how smartest you are. It is actually lasting and adapting and being resilient to the change, which is the maximum chance of survival and eventually prospering. And therefore, growth is a great evidence of that. Growth doesn't come as an accident. It happens as I mentioned, the intersection of these three aspects. And without growth, meaningful value cannot be created. A lot of time people talk about investing as value or growth and quality as if all are these very different buckets. And I've never understood this. Value and growth are often talked about as antonyms, and quality and growth at times are talked about as synonyms. And I find it kind of amusing that it really doesn't make any sense to me. It never made sense to me 35 years back. It doesn't make sense to me even today after 35 years, because ultimately investing is all of them. It has to grow. The growth has to be qualitatively sound. Business must have qualitatively superior character. And the overall purchase, that investment is to represent a meaningful value compared to what you think is the value you assign to the business and the price that you're paying. So it can never be only one, or when you can have all the three, why should you be satisfied with only one or two? You must look for all the three, and therefore the worst kind of confusion, it even today produces confusion to me when I read about it, when markets or commentariats talk about value and growth. It has never failed to confuse me in the past. It never fails to confuse me even today. That these are not antonyms, but actually perfect complementary twins. And quality and the growth similarly. Even if they are treated as synonyms, they are not synonyms. Therefore, growth is vital. In nature also, without growth, things regress eventually. Therefore, in businesses, degradation occurs much faster if the growth doesn't occur. Secondly, more than the growth, or as much as growth is vital, I think there are three other things which I think are very vital. One is the predictability of the growth. Second is the durability of the growth. And third is the resilience of the growth. And all three are very different. Predictability is not the same thing is an outcome which has happened. It is one thing that an outcome has happened. It is another thing that you had a reasonable handle to predict that it is likely to happen. The first one invariably will have a lower value than the second one, even if both achieve exactly the same outcome. In other words, if the two businesses start at the same point, travel the same distance over the same time frame, and therefore both will end up at the same point of time in identical situation, But the second one, which was seen to be predictable right at time zero, while the first one, which was not seen to be so predictable, even though both achieved the same outcome, it is the second business which will have a far higher value in that journey. It is like quantum physics, where it beats your mind that how can observing a phenomena can affect its position, which no amount of intellect can easily help you in unraveling that kind of an answer. I would say this is something similar, that predictability is underrated. When there is something likely to be predictable, even if both the businesses achieve the same outcome, starting at the same point, ending at the same point, the one which is predictable will have a far greater value at the measurement point of time. Secondly, durable, which is simple to understand. Other things being equal, something will go up to a certain distance, even if both the businesses achieve the same rate of change during that period when both travel together. But then the second one takes the lead over the first one and keeps traveling longer and longer while the first one stops. Very clear that the second one will have a much higher value because it is going to travel the distance at a given growth rate for a longer period of time. So that's more mathematical. The third one is the resilience. Resilience or belief about that. Resilience comes from the business character. It comes from the mental makeup of the man who runs the business. Both provide you resilience. What is seen to be resilient, both the business and the management, will have a far greater value than the first one, even if both during that identical journey have achieved equal outcome. Therefore, predictability, durability, and resilience, judgment of resilience and tenacity, ability to last and last and last, or to prevail over your situations. These three have as important an impact on value creation as the growth rate in itself. If not, probably a bit more in my opinion. In any case, if value creation is mathematically is a function of the underlying growth rate, that value creation is much value creation is much higher than the underlying growth rate, simply because of these three factors that I talked about. Third is the quality of growth. The quality of growth is evidenced in, or the character is evidenced in superior capital efficiency, which is superior return on capital employed, superior return on equity, reflected in superior balance sheet, ability of a business to get the same outcome with less or using the same resources to get a bigger outcome than before is a definition of quality. The other things being equal, quality allows you to prevail over challenges. Quality gives you durability. And therefore, quality is not merely a fancy word. It is not merely a kind of a shibboleth or a fetish or an article of display or to sound it very fashionably right. And quality is very real part of investment economics. It is the quality which makes the business prevail and make it last, make it more resilient, make it more durable. And the quality allows many outcomes which right at the beginning you may or may not always be able to fully forecast. You can't fully comprehend all of that, but it allows those potential optionalities which quality, as it unfolds, lets you get into. Therefore, quality is a very, very real third lever for value creation. Therefore, it is growth. Second is what makes growth pervasive. Third is the quality of the growth. And so these, I would say, are really the most important ideas to my mind to kind of figure about business that is relatively less known to you or you're less familiar with. But even when business is more familiar, you always want to test that this is what it is, sustaining and remaining or not.
And so when you speak about predictability, what makes a business predictable? What do you look at to predict? Because it's very hard to predict something. Where does predictability comes from? How do you see a growth? How do you find predictable growth? What's the mindset?
The thing, it may differ from business to business. Some businesses automatically lend themselves to more predictability. Some other businesses require a greater leap of faith.
Can you give some examples of businesses?
Right. So, for example, uh, if you have if you've been an innovator in pharmaceuticals, and here is in a wonder here you are with a wonder drug which has been just approved in an area which is a large therapeutic segment in an area of need where there is nothing contemporary competitor which is similar or closer to you, then you know that the next few years of an outcome for that is something which is deterministic, that you know what is likely to happen. Now, this is much more simple to appreciate or understand when there is something which is sanctioned legal monopoly that you get, because you patent it, you have the drug has been tested, and you know the efficacy, you know the size of opportunity in that area, and because you know that other solutions in the market are not as good or comparable, you know you have a huge right to walk ahead. Something like NVIDIA, for example, if you got your quantum AI chips and you know that Intel is nowhere in the picture or AMD still has a lot of miles to walk before anything similar may come by, no wonder that you know that NVIDIA is going to make a lot of money for length of time. NVIDIA may make a lot of money because it is numero uno in chips that it has developed, which you know there is a huge demand, and artificial intelligence is driving tremendous amount of uh, work to be deployed using brute power of AI, which requires brute computing power, which only these chips can provide. Since you know that there is nothing else in sight, you know that they'll make a lot of money. But at the end of the day, things can change. And so your competition is working and working. It's only when they develop something that is the time you know whether they've got something or not. Like the race between AMD and Intel. For the entire length of time over last 4 5 decades, it is Intel which has been the lead one, and AMD has always been behind the curve. For decades, it has been the case. It's interesting that it has lasted and survived and has not gone down. But if you see the last few years, AMD has taken over, and Intel is now, in all probability, a case for being sold out, while AMD is chugging along and growing, both in terms of the business capability as well as the market value. The same power, which is evidence either in form of a granted monopoly, like a patented drug, or a commercial monopoly like chips made by NVIDIA, ultimately at some stage, something can happen which will take away the power. And that, by and large, world will recognize only when the something actually happens and which can defy that continuing power or predictability. Till then, the incumbent will prevail. Then businesses like, standard consumer businesses have a reasonably good predictability, depending upon the context. Uh, uh, a business of soap and shampoo may or may not have great predictability in a developed market, because more or less usage is saturated. Everybody who can be a customer is already a customer. Therefore, only way you will be growing will be by taking away somebody else's share, which is never an easy game. Either you come up with a better product, or more often you convince others that you have a better product, which is creating that mental illusion, brand, whatever, that you have a better thing. Uh, Always a tougher game. And therefore, predictability goes away in such businesses, and therefore, pricing power goes away. Therefore, the value becomes held hostage to vagaries. In country like India, too, many of the typical consumer staples that one has been bred on the diet of, both as a consumer as well as an investor. For decades, one has seen them to be stable, decently growing, typically double-digit kind of a growth rate, long runway to grow. But many of those businesses have lost vitality. They no longer, many of those businesses in India have now become reasonably saturated. Therefore, by and large, you have found out all the customers who are likely to be the customers. Given the size of India and given the low per capita income of India, still that saturation is never a perfect saturation like you will find in the developed world. But you can see the degree of that saturation being creeping in, and markets recognize that. Even when such businesses grow for some length of time, markets will keep giving them diminishing kind of regard for that continuity of that growth rate. Even if it is growing, it is not degrowing or it is not stagnant. Like many of the such businesses may end up in the developed world. But markets recognize that reality. Newspapers is something similar. Fuddy-duddy individual like me still reads newspaper and is a buyer of the newspaper and consumer of it. But a very large part, for all you know, you may not be, he may not be. And therefore, you know that even if newspapers in India are still growing, but you know that it is finite and it is going to reach a point of negative inflection at some stage or a stagnant inflection. So, the size of opportunity, judgment of that, durability of that opportunity, all of the feed into the predictability. And what aids to the predictability is your judgment on the character of management, a fighter, a resilient, driven management, which through the challenges will innovate and find out a way to deal with the challenges which will come. All of these link to the differing shades of predictability.
I have questions about all the three things that you mentioned: the NVIDIA example, the pharma example, and the consumer example. So, for example, NVIDIA, sir, there is predictability because of the so and so reason that we mentioned, right? AI is coming, their chips will be. But you also speak about the price value gap and the margin of safety. The predictability is there, but how do you know there is a difference between price and value and the enough margin of safety to get into something like that?
Never easy to answer for something like these chips business. But there is also something in that area, that there is a lead time for development. To get something new up and going will take a given amount of time. It's not going to happen simply because opportunity is there and here NVIDIA has declared its product and is fully sold out. That a competitor, even if sees the opportunity, will be able to convert into an outcome, even if it works 24/7, puts all resources at command, talent, resources, money, facility, everything. Still, there is a lead time. So you have some idea what that lead time would be, or you have some measurement mechanism to judge that lead time. And to that extent, NVIDIA will not have a value as if it's a continuing business forever. NVIDIA will have value today for relatively more finite future discounted to the present. But in that finite period of time in the future, it may produce some blockbuster numbers, and those blockbuster numbers then you are discounting to the present and still produces a blockbuster number. Even when you discount it over that limited finite period, because you are assigning some risk that it will not necessarily last forever. History shows in all of these businesses that the advantages at some stage get chewed away. Management's businesses acquire sense of complacency, sense of satisfaction. Innovation and strength may lose over the period of time. Somebody else has a greater hunger, greater capability to find out, to become a new upstart and a new challenger, and some of them may succeed. And therefore, history shows that invariably this occurs. Therefore, the advantage is something that you're not replicating for forever period of time, like a soap or a shampoo or a toothpaste kind. And that equation, in a way, is more rugged, that there are so many potential customers or population who may use a product. How much is on an average product usage may be needed. Therefore, how much is the total size of opportunity, premiumize that, and how much it can become more. And all of that can be converted based on the penetration rate and all that for a relatively more predictable longer term outcome. That kind of predictability you can't put about NVIDIA. That kind of predictability will be higher for a blockbuster patented drug of a pharmaceutical variety, because outcomes are almost certain. When it is something put to the market that you know that it will have a few billion or whatever number $1 billion of money to be made in a given period, and legally sanctioned monopoly can't be challenged. Even in a business like this, easily the advantage is not chewed away by the newcomer. Therefore, whether AMD works or some new player comes by or some new startup comes by, you know that it will take some time before something like this may get withered away. Now, whether that is 5 years, 6 years, 7 years, 8 years, partly is a matter of judgment, partly your serendipity, partly is a matter of the context of the data that you are looking at and you believe in. It can't be converted into a very perfect mathematics, but it is a good judgment that you can make. If you have entered early enough, then very fine calculation may not be needed, nor you may be capable of, but margin of safety may be so large that it doesn't matter. On the other hand, are businesses like, say, EMS businesses, electronic manufacturing service businesses, that India is now embarked upon. Yes. Whether manufacturing mobile devices like Foxconns and others are doing in India now, where suddenly mobile phones have become an item of export for India rather than significant item of import. What we imported 5 years back, we are exporting more than that today per annum. Some 1 lakh 20, 1 lakh 30,000 crore today compared to 1 lakh 10,000 crore of imports 5 years back. Or it can be consumer durables. Dixon is doing along with the consumer durables. It is lighting and other products. It has got mobile phone, which has become the most significant part of the business. Plus new manufacturing ecosystem, either of components or of the telecom devices or computing devices that they are embarking upon. All of that ecosystem is evidenced by a certain order book. And therefore, that order book lends to the greater predictability. Now, order book is That order book advantage is not of the same kind as a patented drug of a blockbuster variety, which is typically a drug may take 6, 7, 8 years out of 20 years of protection to come to the commercial birth. So you know that unless something else competitively alters the value proposition, you've got 10, 12 years of staggering amount of money to be made, and you know how to play that game. Here the order books are for a shorter period, and order books can go away. It is not as if it is cast in stone that what is order book necessarily has to happen in a given time frame and has to happen irrespective of anything, because order books are in some sense marriage of the two entities, the customer and the producer, that we intend, and then there is some evidence, maybe there are some take or pay clauses and some other things which may help, but not all orders are like that, and it is really speaking based on the mutuality that these order books are worked out, and these are typically for a shorter period. Therefore, these order books give you, on one hand, a certainty in some sense of likely outcome for next 2 years, 3 years. But at the same time, there is some level of uncertainty that it, despite the order book, final outcome can differ. Both as to timing is as much as to the quantum. And you have to keep in mind that possibility of the risk factor. What may increase that predictability will be that, for example, that if a company like Dixon is making mobile phones but is entering into components, which is even a greater value add because it is the components which adds to the great part of the value addition. Today, Dixon is about 15, 16% value add in mobile devices, but with the components, it can go to 35%, 40%, and therefore it improves your invincibility, relative invincibility to the customer, your person who has contracted with you, much more, because he knows that you have your own destiny under much higher control. Therefore, there are offshoots, there are possibilities, there are optionalities which get created. Using the same capability, and many assets are fungible. It allows you to get into maybe telecom products, allows you to get into computing devices like tablets and others. And therefore, there is some level of optionalities and additionalities that you know can come to your benefit. Therefore, there is a predictability. But nothing in life, as much in businesses, is 100% certain. Everything is a probability. It is the game is to define how much probability is more credible and how much of the probability looks guesswork and completely like a chance. And therefore, life is a series of probabilities, much like evolution of the species. Evolution of the businesses have templates of that predictability based on either a licensed drug or based on a great new product that a chip maker has developed, or a very competent EMS producer who commands order book of many customers because they see value in all of that. All offer you different kind, or that of a consumer franchise evidenced by a brand and its salience, that a product has received consumer acceptance, and given the fact that there are so many consumers, so many more may come based on penetration rate and the likely growth based on the income projections of the growth that you forecast, some level of forecast on premiumization, and therefore you have some sense of predictability of that. Each business is a predictability, but of a different kind. The shade, the extent, the period all may vary. And nothing is cast in mathematical certainty. Even mathematics is not cast in full certainty, as much as people may think. But nothing is cast in that remarkable degree of certainty. Everything is probabilistic. And it is the degree of probabilistic outcome is what one is kind of making judgment about.
I was reading your line where you mentioned that markets are discounting machines.
Yes.
And you have to, when you understand, when you find the predictability in any business, you have to act before the market discounts it. How do you do that? How do you act on the understanding of predictability of growth of a particular business before the market discounts it in the price and everything?
Markets are a phenomenal discounting machines. Ferocious, forever, unrelenting, and super fast. All of those qualities are inherent characteristic of the market. That they are forever fiercely futuristic, fast discounting machines. No human, however driven, however capable, however willing, can hope to match this as a package on an ongoing basis. It is humanly impossible. I don't think there is any, forget about me as an individual to be able to do it, but far better investors than I also cannot match with the market sort of say ferocity in its relentlessness, so to say. Uh, but markets are generous. They yield to you if you behave. You treat markets with respect, probably bordering on reverence, then markets slowly, steadily, they yield to you. They let you partake of its grace. When you try to be, so to say, very presumptive, when you try to act very smart with the markets, chances are that sooner rather than later, markets will get an account of you and make probably mincemeat out of you. Therefore, understanding the power of the markets, understanding its overall genius, that how markets crunching, analyzing terabytes of data and constantly keep getting aided, which is beyond any human comprehension and capability, still can come up with, by and large, good judgments over a period of time. But time to time, or at a particular points of time, markets can flip, can make a perfectly bad decision, can make a perfectly irrational decision. Recognizing those crunch moments, recognizing those vulnerability points, because markets also are vulnerable at that point. That is where you have a possible advantage in getting ahead of the markets.
Can you give an example of that crunch movement that happened in your life, sir?
All the time. I mean, time to time, like human beings, markets are nothing but an aggregate of or sum total of human frailties, egos, arrogance, misbehavior, indiscipline, losing wisdom, human final human endeavors and outcomes are a sum total of many of these all the time. Markets also represent the sum total of many of these, of unbelievable brilliance at a point of time, as well as perfectly irrational and outrageous behavior, complete lack of discipline at some other point of time, or complete miscarriage of justice at some other points of time. Therefore, cycles are forever in the market.
Mhm.
Cycles are not one time because human behavior remains what it is for a length of time. 4.3 years of 4.3 million years of evolution of Homo sapiens has shown that these things take a huge amount of time before they change, if at all. And therefore human lives go through cycles, partly due to exigencies, but also due to the endogenous factors within the person participating in the market. Therefore, exogenous factors being what they are, but endogenous factors decide human behavior and the ups and downs and the cyclicality of outcomes for the human life, given a package of talent, weaknesses, all that individual may represent. Markets similarly represent sum total of many of the brilliant capabilities as well as vulnerabilities, peevishness, at times perversities and weaknesses. Therefore, much like human lives are spent in living from one cycle to another and hopefully learning and behaving better, which may at a microcosm level, at an individual level may be possible. But at a macrocosm level of the humanity, that almost is deterministic that humans don't learn is an aggregate. Therefore, that cyclicality at an aggregate level invariably continues. At an individual level, a great learner or a worst learner will have obviously cycles different from the aggregated cycle of the humanity. Markets is an aggregate. Therefore, we'll have a cycle forever of the pluses, of the minuses, undiluted elation at success, and very defeatist pessimism in the downturn. At sometimes punch drunk, at other times manic depressive entity. These behavior pattern of the market will forever occur. And degree may vary. It may be very punch drunk at a point of time where a tulip bulb can sell for a mansion. And it may represent complete frustration with the life where flu kind of a disease can make prices go down third or the fourth of the value. And therefore, both the extremities time to time will occur. But mostly you don't see extremities of this kind. Therefore, volatility is forever. The exaggerated volatility less frequently, but will still occur often enough. Violence of the kind that I described, either on up or down, also will occur, but with the least amount of cyclicality. And I suspect that technology somehow has made these cycles crunch in duration but amplify in outcomes. I don't have any full-fledged thesis to prove this, but I definitely suspect that a lot of technology has a deep impact on the psychological behavior.
Can you give an example of this where technology had a deep impact on psychological behavior of
I
humans?
mean, it's every day,
In Indian markets?
everywhere. Your WhatsApp, your Instagram, your Facebook make you attention deficit individual, make you give a priority on urgent rather than important, give a priority to frivolous rather than deep, and give undue importance to meaningless, facetious conversation over deeper engagement with a family or a dear friend. All these, we are seeing it all the time. And how it is at an aggregate level changing and altering the behavior of society so very quickly that friends who are out on dinner and instead of conversing are time to time checking their phones. Family sitting on dinner together instead of having conversation are trying to find out what is happening on the latest notification. And this is happening pretty rapidly. The fact that psychological reactions, young people are developing depression. The youth, the people of 10 and 12 and 14 years develop depression out of engineered comparisons of the Instagram variety or Facebook variety, and God knows all those horribly addictive social media platforms are, who constantly work at appealing to these base emotions and addictive impulses of the consumers, which is why perhaps Australia thought that less than 15 years, no, you're back. Maybe,
social media.
I mean, one may think that this is against free choice, but probably right thing in my opinion. Who knows? Technology altering human behavior is dramatic. I mean, it hardly requires any example. There are millions of examples of this galore. The point is, you have an advantage in beating the markets when markets go through the crunch moments, because time to time, that ferocious, fiercely fast, futuristic machine discounting zillions of data piece, which you can't beat at that game. But you can beat them at that game in that volatility or exaggerated volatility or violence. If you do not allow that to become your own alter ego as well. In other words, you subjugate your internal noise and sublimate external noise in order to remain watchful of what is happening without succumbing to the charms or the pressures of what is happening. Then you have a chance.
And how do you do that? How do you
That's psychology.
clutter that noise? The internal and external noise.
That's entirely internal. Whether you are aware of this, B, whether you have a self-discipline that when you are aware, intellect will make you aware. But it is your internal discipline which will make you disciplined. It is refining your mind, refining your behavior, which will let you have wisdom to do what is right rather than what may be fashionable. And therefore, it is not intellect which is the greatest right to win in investing. Surely, it can't be nothing as well. You have to have some meaningful graces in your between 2 years, but you don't need to be a genius. It is your temperament, it is your character, it is your wisdom, and it is the discipline, which has far, far greater impact on the final outcome. And to a varying degree, each of the four either is almost entirely within and you can't do much about it, or to some extent they can be improvised and they can be improved and they can be developed. But to a differing degree, or relatively smaller degree, this can be improvised and materially be improved. To a large extent, those are hard-coded in your DNA, in your brain, the way you are, the way you have evolved as an individual. And finally, as far as businesses are concerned, when markets are normal, there are no special moments, there are no extremities. It's purely a matter of hard work that you have done, matter of judgment that you have developed, matter of conviction that you have developed, and also the fact of the knowledge that markets give a primacy to near term, even if less important, at the expense of primacy of the future, even if it is more substantial. That's a heuristic behavior of the market, to put a premium on immediacy at the expense of distance. And that behavior allows you to have a reasonable confidence if you can understand the size of opportunity, if you can believe it will be predictable, if you think it will last long enough, and their market behavior heuristic advantage can come to your way, because market will give a greater attention to near term. Not that it is unaware of the future, but it tends as a machine to get a greater preference to the near term. And it puts a lot of hazy discount on the relatively greater distant future. Therefore, if you have identified something with a large opportunity size in your mind, with a greater prevalence characteristics of predictability and durability and resilience, and that is wrapped into superior character of capital efficiency, superior quality, you have then an advantage. And the greatest strength there is the patience. If you have patience, then I think that's where markets, you gain an upper hand and an advantage compared to the markets on that particular business. To the aggregate of market, you get an advantage during market vulnerability points.
What point are
Vulnerability points, actually. So, yeah.
Can you also give us an example of how do we size the opportunity of something in a right manner?
So that a rupee into Infosys, I had opportunity to see it go to 250. And a rupee put into VisualSoft, I had an opportunity to see it going to some 300 rupee. Or a Wipro going even longer mile, but in a briefer time, and then reducing also the faster. Therefore, opportunity size, its continuity, therefore likely growth rate, management, its difference, character, and global relevance. And it sounded like a nirvana, breath of fresh air is an opportunity. Being at the right place at the right time where this opportunity beckon, and having some amount of probably understanding and analytics that here is different, and therefore it must be treated as special rather than ordinary. And maybe only act of wisdom I would say on my part is I had probably patience to see something going from 1 to 200, 300, and yet not disengage. But therein lies the negative also. The same probably patience allowed me to last all the way to the top on those stocks. That patience had to end at a valuation measurement point, which should have taken into account that with each rise, my margin of safety is eroding materially, and I have already crossed the point of time where margin of safety is not any longer in my favor, and therefore, however good it is, this cannot last, and therefore I had to disengage. Therefore, if I claim some credit for that wisdom
To get in at
and
the
for
right.
that patience, equally I deserve a kind of a slap on the face for elongating that journey way too long. For me, those stocks were a perfect example of zenith of elation, as well as, like they say, apogee and perigee points. The most horrendous thing to be witnessed, where a visual soft can go from 3940 to some 10,500 and can then comes down to 3,000, which is when I woke up from my sleep or reverie. That meant 42 to 10,500 was a fantastic journey, but 10,500 has come down to now 3,000, which is when I woke up from the reverie and began to take action. In some of my more foolish moments, or particularly more stupid moments, I used to take pride that, look, my network, which prior to these names was very little to talk about, because coming from a rather modest, lower end,
Right.
middle class family with no capital, nothing, and therefore had to depend on working for somebody in order to leave the living. And paymasters in 80s and 90s and even in 2000 were nothing much to write home about. That you could have, barring leaving, you could have really produced much capital. But determined investor that I was, or the saver I that was, that I tended to have less expense and hopefully expand income and put it all to the work. I used to break that some 75-80% of my net worth is in just 3-4 names: Infosys, Visualsoft, Hindustan Lever, and Wipro. And I used to indulge in a secret addictive pleasure within that, look, how smart and how clever I am, that I have got into this. They have suddenly made a very material difference to my wealth and my worldview about myself, about the opportunity around, and in some way view about my own self as to what I can do or I have done. It was an utter act of foolishness, utter act of immodesty. Even if these answers were not volunteered on my own, but when some people who observed and who well-wishers and others, knowing that I was positive on many of these businesses and was there for a length of time, and dramatic change in the fortunes of 3 of those 4 businesses. Hindustan Lever, significant but paled by comparison to the other 3, but still material at that point of time. People inquired, and I used to volunteer, indulging in that somewhat egregious kind of a perverse pleasure within the mind that, how smart I am. Only when I woke up from that reverie, then I realized that it was actual nightmare. Therefore, wisdom and patience. Wisdom lied in patience. And I would say in that initial material part of journey was an intelligent patience. I think when I crossed the Rubicon and when that patience no longer was intelligent one, but a careless patience, that is where the act of deep self-failure came to be, the seeds were planted. Of course, I was not wise enough to recognize it then, otherwise I would have cut it off at that point of time. I was foolish enough to recognize it only after fair bit of damage had already done. So one way to look at it was that even from the initial point, it was still so much more, 80 times, 100 times more. But from where it could have been, it was so much less. I would say, I think that was a big, big learning. And a lot of time people say expensive learning, but I don't look at it that way. I think good learning is never expensive. In financial term, it may look like that you the outcome compared to what it could have been at that point of time, what you had to finally settle for was diminished one. And therefore, how to prevent such apocalyptic kind of foolish behavioral failures, how to avoid them, clearly was a great learning. Therefore, in financial terms, to me, it made a material difference in terms of the erosion that I suffered. But, not just for me, but for the fund, even more importantly, that it suffered because the same Infosys, which was bought at two-digit price, on the top probably went up to some 16,500 or something like that. And same results of which we bought at some 39, 40 rupee, and a percentage equity of the firm in one go. I saw it all the way to some 10,500 rupees. So and far more important, my duty as a trustee of people's money, and in a way less important but critical, as a trustee of my own money. There was a huge learning that episode gave. Therefore, no regrets. I would not regard it as an expensive lesson. I would regard it as a very powerful lesson that life taught.
At this point, you closely as a group manage $10 million plus of AUM, right? And you have the fiduciary responsibility towards the hard-earned money of your clients. Do you fear losing that money, or how? Or let me put this way: how do you balance between wealth preservation, that whatever amount of money that we have has to be preserved first, and the balance between that thing and actually go on and take some kind of risk in the market to appreciate that wealth? How do you deal with that fear, or how do you balance between preservation and taking risk to appreciate? Because you have the fiduciary responsibility, and it's a huge, humongous amount of money.
Investing is a fiduciary responsibility, first and foremost.
If you're managing someone's money,
I would say even for your own money. You are a trustee of your own money. You don't have an unlimited, unfettered right to do anything that you wish. Because that wealth, that portfolio, you are holding on behalf of your family as well. And you have a responsibility for them. So I would say fiduciary duty extends both to the when you are managing other people's money as well as to your own money. Of course, degree and primacy of the other people's money is first and foremost. That goes without saying, because that's the first duty that you have. Like nation before self, the same idea that obviously when you are managing other people's money, that becomes the first primacy and the first important, the most important fiduciary responsibility. Psychologically and in terms of mental framework, to think of your own money is you having an unfettered, unlimited right to do whatever is a very bad investment behavior to have. Because if you have such a notion, it will somehow show up in the way you do it for other people as well. Because if you can't treat your own money with the kind of dignity and the kind of balance and the kind of risk control that you must exercise, and if you start thinking that you have any right to do whatever with that money and take any kind of a chance, even getting carried away by that extremity of a thought, that behavioral pattern can't be compartmentalized for other people's money. Therefore, it is likely to spill over when you act on behalf of the others. And therefore, I never believe that money to be managed for others and money to be managed for self needs to be treated in a very different way. Primacy, clearly fiduciary's first highest level responsibility is other people's money, but not less for your own money. Treat it with the same dignity, same accord, same discipline, same behavioral maturity. Secondly, I've been mentoring my team for last several years. Last 5 years or so, I've been mentoring. They, by and large, make the decisions. They do things. But I ferociously remain engaged with the businesses and evaluating and understanding, perhaps even more than my team members may be willing to do at points of time. And because that's a passion, that's a love. And I will never ever step away from the businesses and knowing them. Even if I'm helping my team members in mentoring and suggesting, and then they make the choices. But investing has to be done with the self-experience. It cannot be based on merely borrowed idea. It cannot be merely suggestions. You can't do investing as a laboratory experiment. You have to do it yourself. You have to be in the thick of it yourself for you to have an ability to mentor well. Otherwise, you can't do that mentoring adequately. Third, how to achieve balance. I don't think that is such a challenging one. Two important ideas to my mind, and both to my mind remain paramount. Absolute and relative returns, capital preservation and capital appreciation is a second piece. Both are pairs. Absolute and relative sound like two different things, and they are in many important ways. Preservation and appreciation sound different things, and they are in some very important ways. But in many important ways, both are linked together. Fundamentally, mindset, I believe, from a risk management point of view, has to be that of preservation. And expansionary mindset enables you to achieve appreciation. And you need both. You need a mindset which is aimed at controlling your risk and not getting carried away by undue amount of benefit of the extremity. At the same time, an hungry, expansionary mind, which is not satisfied with banal but more distinguished outcome, is a growth mindset. And that allows you to enjoy the fruits of capital appreciation. But mindset which determines capital preservation is actually the mind which lets you enjoy the fruits of appreciation. In other words, capital preservation mindset has an indelible impact on your ability to generate and enjoy the fruits of capital appreciation. Appreciation cannot exist in isolation of the preservation mindset. It is not as if this or that. Therefore, capital preservation mindset is a mother mindset. And with that, a very powerful progeny of capital appreciation comes out. The mindset of absolute, again, is something similar. That you fiercely are focused on ensuring that outcome on an absolute basis is satisfying over a period of time. It is not a mug's game of a relative comparison all the time that you are trapped into. And therefore, absolute mindset, in a way, is a mindset which is aimed at controlling risk. It links with that preservation mindset that every capital injection must generate a positive outcome over a period of time. The beauty is absolute mindset generates byproduct outcome of relative superior outcomes as well. Relative superiority of an outcome over a period of time is a sum total of absolute mindset practice at various shorter intervals of the time, which leads to producing that superior outcome over that time frame. It may or may not produce in each intervening those series of periods over which you have practiced your absolute mindset. But over a material period of time, which is a sum total of many of these intervening shorter time frames, will invariably lead to a superior overall outcome. In other words, absolutist mindset, a purist mindset is a progeny, produces a very healthful progeny of a relative superiority. But you can't compartmentalize. And it is not this or that. It is absolute, which makes you happiness plus relative better outcome.
So how do you balance between your loyalty and friendship with the guy at a point where everyone in the world is perceiving him or her a very bad person? But you have
Investing
the loyalty.
mindset teaches you that.
How?
It allows you to focus on what is core and what is non-core. It allows you to view things as not white or black, but a mixed blend of the two. It allows you to recognize strengths of a business, but also makes you recognize fragility and weaknesses. It allows you to recognize an opportunity, but at the same time, it allows you to recognize the lurking vulnerability or threat. The same mindset allows you to look at people in the same mindset. No person is black and white. It's always a shade of gray. And all relationships are nurtured probabilistic outcomes done with care, clarity, and with right kind of filters applied. All relationships over a period of time are an outcome of that very careful appreciation of the plus and minuses. Nothing is devoid of that. And it is our own either mental fog or arrogance or weakness to think of it anything other than this. Nothing, no relationship in the world which is worth retaining and developing can only look at only the positives and assume complete lack of negatives. It is impossible. So I don't have any such view at all.
Very insightful.
That ultimately mindset of an absolutist or absolutism is the only way to earn superior return.
What's the difference between the two? Can you just help me understand?
Between
The absolutism and the one you are saying.
no, I'm just saying the same thing. The mindset of absolutism, which is to seek a deterministic outcome in itself, irrespective of anything, is fundamental building block to generate a relatively satisfying outcome as well. The purity of absolutism is a path to the satisfaction of the relative superiority. If you look at human behavior, happiness is an objective everybody looks for. Happiness is an absolute is an idea, is like an absolute idea. Right. Happiness per se, if you think about it, has to be an absolute idea that what makes you feel good and pleased in the mental space. But in practice, it doesn't behave that way. You're not happy merely because you have enough, say, for example, wealth to take care of your creature comfort. You are happy only if you, relatively compared to Malhar, feel that you are more. It is that behavioral pattern. While pursuit of purity lies in absolute, but a miscarried pursuit happens in the search for relativity. Therefore, happiness can only be derived as an absolute idea. You can be happy only if in your mind what gives you that contentedness, and getting that will just make you feel impervious to what is happening outside you. That is true happiness. But you are happy not only because you are, say, for example, various things that can give you happiness. Say, you are wealthy, but you are happy because you are more rich than relevant set around you. Even if that amount is less than absolute amount, that may be good enough to give you that mental space. So that perversity in the human behavior gets mixed up in the lost phase of relativity, while satisfaction lies in absolutism. But the beauty is, like preservation is a route for appreciation, purity of absolutism is a route for relative happiness and superiority as well. And therefore, the two together, the twin pairs of absolute and relative, and preservation and appreciation, remain to my mind indelible, powerful, enabling forces of how to view value creation journey, wealth building, and acquiring, so to say, economic milestones over the period of time. I've said all this about economics and wealth and money, but the same thing applies to many other aspects which determine happiness.
And was it
Like for me, the learning opportunity that investing provides is far, far more powerful and far bigger driver of what is to be done in life. Uh, I mean, wealth is important, money is important, recognition, regard, all of that external amplification and embellishments are all important. I'll not say that one has to be a monk in Himalaya and forget about all of that. But I would say while they are important, but to a point, and to my mind, they are byproducts of the purity of absolute. And what are those purity of absolute ideas? A, learning. Phenomenal learning opportunity of a kind that nothing else in the world, to my mind, is this profession gives you in diverse branches of knowledge, whether it is physics, whether it is spirituality, whether it is economics, or whether it is literature, whether it is poetry, or it is about space, whether it is finance, or whether it is human behavior. So many branches of knowledge, so many practical and physical sciences impinge in order to keep building a framework for learning all the time. To me, That absolute reward is the most important reward. Wealth and other things are byproducts, important ones, but byproducts. Trusteeship, discharging the faith of people who believe and trust you, is a very important, both a responsibility as well as great source of satisfaction. Third, getting a good outcome of the pursuit of the joust with Mr. Market. Never easy affair. Mr. Market is supreme always in my eyes. I always, in my mental framework, lie prostrate before Mr. Market with reverence. But jousting with Mr. Market and time to time winning is a great, both intellectual gratification as well as source of deep satisfaction. And finally, I think good investing allows you to reach milestones which liberates you from the compulsion to do things that you have to do rather than what you want to do. In other words, it gives you choice of time. It liberates you from tyranny of what you have to do as work rather than what you choose to do as work. And therefore, good investing allows you to reach important economic milestones way early in life, that it lets you pursue what gives you maximum pleasure and maximum satisfaction. And it gives you choice of time, which is the greatest treasure you can always have. The liberty of time, the time at your hand, in your way, in the way you want to use it, is a great liberty to have. I think pursuit of the purity of all of these absolutes is a foundation of also getting relative outcomes which are important, but they just happen. Whether you call it riches, whether you call it wealth, whether you call it recognition, regard, whatever.
But there is a balance also. For example, young people have less capital but a lot of energy and time. But people who are on the end side have more capital but less energy and time. Do you think so?
No, not at all.
Are there certain things that you
100%
could do when you were 20 or 30 years of age?
energy, when you define it only in a physical sense, then it may be correct. But energy is not physical only. Energy is a lot of mental energy, energy to think, energy to reflect, energy to get engaged with diverse issues. And you have, in fact, you have a lot of time to do it. Investing liberates you in terms of time.
How?
Because it lets you do the work that you want to do rather than you have to do. You may end up working, let us say, you may work as, say for example, an executive in marketing or a manager in marketing in a firm. Whether that's your calling card or whether that's a joy in the life, with a good firm, with a good pay, it gives you security and satisfaction, and therefore it compels you to do. And therefore it compels you to do several things along with it, which may or may not add anything to you.
Right. True.
Those endless amount of things that you do and endless amount of parties that you may indulge in, you may or may not want it, but you may have to do, and it may add nothing to you.
Right.
Good investing gives you confidence and economic resources to make your choices in your life. Therefore, you do only those things that you want to and love to, rather than you have to. Therefore, I don't at all agree with you that older at the as you advance in age, you have more capital and less energy. On the contrary, I've never found, talk personally, in my mental energy ever anything less than 16 or 18-year-old, 20-year-old youth. I've never felt ever. The day I feel wanting on that, I may have to reflect on that. That maybe my gray cells are slowing down or my energy has nothing at all to do with any of this. It's complete nonsense. Equally, young people may not have time. The biggest and more, because they have to do things in order to get through the motions of life.
Right.
They have compulsions. They don't have choices. And they may have to do what they have to do. They may have to do what the boss tells them to do. Or the senior person in the family, even if it is inappropriate, may be required to do. Or it may not have choices in many matters. And whether they necessarily have more energy. A young person engage in WhatsApp and engage in Instagram and Facebook, like they say, some 7 or 8 hours a day. What energy it is? In my opinion, it's a worst dissipation of energy. It is the worst crime that you can do to your energy. What kind of energy is that? I see no outcome for that energy at all.
I'm super grateful, really grateful, sir.
No. My pleasure, absolutely my pleasure.
Thanks a ton for doing this. Really grateful.
No, my pleasure, absolutely.